Natch, thanks for taking the time. Thanks for doing this. Just to kick us off, could you maybe just give us a little background of your academic and then career progression? Maybe start with, why you chose the subjects you did for like university and things like that.
Yeah. So, well, thank you for inviting me. It's a pleasure. So, yeah, sure. So, I studied in Madrid. So I was born in Madrid. I was raised in Madrid. Well, I moved around Spain, and then when I reached the point of choosing my university or choosing my or my undergraduate, I really liked maths and physics. So I decided to go to do engineering. I did civil engineering just because I didn't like things moving. So I preferred concrete and bridges. So I studied that. Did 1 year in Germany, my last year of my undergraduate. And it was then when I realized I was maybe my personality was not fit for engineering per se. So I thought I was more of a social guy. I wanted to I think you also work in groups and in teams, etc. in engineering, but I also wanted to have more of a human touch, right? So then I spoke with a friend. He told me finance has a bit more maths, so maybe try finance instead of management or economics. So I thought, okay. Then I went to the IE University, where I met you, to study a master's in finance, and then
I said in the one of the newsletters this week, I said we had the pleasure of sitting next to each other for about 6 months, no?
Correct. So you know that I was not that good at maths. but I liked them.
Yeah. So
anyways,
so you then did master in finance at IE Business School, and what?
Without knowing anything about finance, so it was a bit of a leap of faith.
Yeah. How did you find that?
I actually enjoyed it. I enjoyed it a lot. I thought it was a really nice balance between something that was intellectually challenging and let's say scientifically, or I don't know how to say, academically there was a lot of rigor in the the maths and in the calculations behind finance, but at the same time there was that art part of it or human part of it of being unpredictable. So I really like that balance. Like, you know what they say of it's a mix of art and science.
Yeah. It's like when
it was good.
It's like when they talk about behavioral finance. There's like the scientific part, but the art.
Correct. I really enjoyed it.
But a question, like, why did you go from, so like people who might be listening to or watching, like, why did you decide to do a master in finance after undergrad instead of going straight into finance? Because some people go from engineering straight into finance, no?
Yeah. So the honest answer was I tried to go straight into finance, but it was a bit late in the year. So I decided I wanted to do finance, or at least not continue with my civil engineering studies. I think it was January, February. The master's applications were already closing. Spring weeks were out. Summer internships were almost filled. So, and then my father thought it was very important to do a master's and finish with a master's. He thought it was going to be very important for my career and in the future. So he thought finishing your studies, if you don't do it once you are in like studying age, is very difficult. You can always do an MBA like you're doing, right? And that's a perfectly valid option. And I think it's a very interesting option actually. But I thought it was probably that's the engineering mindset. And I found actually it was the right choice because it gave me, I think, the foundations, or at least the training that I needed to succeed in the internship, and then to have the confidence that I needed throughout the job. So I met a couple of engineers, architects, physicians, mathematicians that had broken directly into finance, and they were obviously very good. And I mean, it's not quantum physics, right? Like everyone can get it, but I think what I got was I think that holistic view from the masters and all that training prepared me very well for the internship and made the transition way smoother and basically prepared me for success, right?
I'll 100% reiterate that in terms of when I joined the Master of Finance as well, because I came from economics and maths, and despite them being very quantitative subjects, like then it's not accounting. It's not finance. You don't learn those things in an economics and like maths degree or engineering degree. And so like without that, I'm not sure what I would have done. Again, it was a huge leap of faith because I remember sitting in class and you're graded on the bell curve, you know, and I remember sitting next to Melissa and she was a trained accountant and we were doing accounting exams. I was like, I've never seen accounting before. Like, this isn't fair. but anyway, okay. So yeah, and then you then moved from there into M&A at Credit Suisse.
Well, so I moved exactly. I moved to the UK M&A team.
Yep.
Right after COVID, so it was an interesting move. I got my offer for the internship say December 2019, and April 2020 I'm speaking with all the teams at Credit Suisse trying to choose. I wanted to do corporate finance.
You went into Credit Suisse straight after IE, no?
Yeah.
But
it was so I did my internship. So we graduated from IE June 2020. 2020, no? Oh, okay. I'm getting on my. Okay, you're right. So 2016. Yes, you're right. You're right. Man, time flies. So almost 10 years ago. Yeah. So, you're right. So I got my offer December 2015.
Yeah.
Then I chose my team in April 2016. My first day was going to be September 2016. Yeah. I was speaking with all the teams. I really liked corporate finance versus markets. Securities and derivatives. So it was a bit more interesting. So I wanted to do M&A or corporate finance advisory. I spoke with the UK team and it was great. They had a great team. They were super nice. They, great franchise. You were covering all the sectors. So I thought, what else? Where else?
And so that wasn't a spring week or graduate. That was actually an off cycle, wasn't it? If I remember.
Yeah. An autumn internship is called, or off cycle, yes.
So you got the off cycle, and then that converted into a graduate program.
Correct. So that converted into the analyst program. Yeah, I got the offer at the end, but in June 2016, Brexit was voted. So when I joined the team, but at the end of the internship, they told me that they were not expanding the UK team, so they didn't have offers in the UK team, and instead they offered me to go to ECM and convertibles. So then I joined the ECM and syndicate desk and convertibles. Yeah.
At Credit Suisse.
At Credit Suisse, I did that for a year, and then I moved to M&A again, industrials.
Interesting. Okay, so how did you find the experience between ECM versus M&A?
I liked it a lot. ECM is way more dynamic. You can be closing. So you are closing transactions. Say in a given month, you can do 3, 4, 5 transactions. You're running a lot of processes in parallel. So you're not doing one IPO. You might be doing 3 IPOs in different stages, right? But you might be doing 3 IPOs. Then you're doing a block trade. You were issuing a convertible next Monday. You're covering, right? Like you're covering a lot of industries, lots of companies. I was focused on the south of Europe, so I was doing Italy, Portugal, Spain, obviously, and Greece. Right. But then in convertibles, I was doing the whole Europe. So it was a bit of, it was very dynamic, ever changing. Every day you would get into the job and suddenly get a call from, I don't know, someone trying to sell 5 million shares in I don't know what company, and you would need to do all the research quickly, get everything in place.
What research are you doing when like you were talking about that?
So what you would do is from the private side, what you prepare is the sales briefing. So it's the document and the evaluation and everything that you will give your sales guys in the public side, and you're in your syndicate desk that sit in between public and private. To speak with the different funds where they're going to sell the shares. Okay. So say, for example, Warren Buffett wants to sell 200 million stake in, I don't know what company, say Bank of America or Apple, right? They would call banks because if he dumps all those shares overnight, the share price will go down. So he just want to get counterparts that are willing to buy that stock. At a given price, so that the stock price doesn't suffer as much, and he can, there's no execution risk. At the same time, there's a lot of funds on the other side that want to build large stakes.
Yeah.
But if they do it over time, the share price will go up. So everyone is incentivized to do that.
You're the
so you would
middleman.
call a bank. Yeah. You would call a bank, then you do like a market sounding where it's all anonymous. So you would call some, you think maybe, I don't know, Janus Henderson, or even
Right.
Schroeder, so whoever is looking at that stock. So you would call them and, hey, I have a company in the banking industry, large bank in the US. Would you be interested? If they say yes, they sign the confidentiality, and then so that is that briefing of, so that they are prepared to sell the stock.
No, okay, no, that's super interesting. And I love the great example then, Ajay. Like that will help, I think, a lot of students. Helps me actually understand it as well. Okay, then M&A. What was the differences? And I mean, I'll come on to later about what you might enjoy or not enjoy about the role. So we'll leave that for now. But what were the differences, and what kind of things do you do in an M&A team? And then we'll talk about PE as well. But in terms of an M&A team, like, what does a graduate, people who are going to be coming out of university, going to an M&A team, what do they actually do? And how does that change as you progress as you get older?
Yeah, so it's a very good question. I would differentiate between two things, right? One is when you are in a live deal and you are doing execution of that deal. Yeah. And the other one is just the pitching and, trying to get more deals. So that is how your work is divided, right? So say it depends on the time of the year, it depends on the team. Like there's teams that have more live projects, there's teams that don't have any deals, and you're doing more pitching and origination, quote unquote. But the idea as an analyst, what you're supposed to do is to know your industry very well, know the comps, know the valuation, know the drivers of the industry.
So which industry were you looking at?
So I was doing industrials. Inside industrials, I was covering chemicals, and then some business services, some building materials, but particularly chemicals, which is a very sexy industry. And
so then what types of work were you doing for the live deal stuff versus the origination stuff? Because I hear it's a lot about presentations, things like that. Is it a lot of financial modeling? What kind of things are you doing?
So everything that you do is divided into sector analysis and sector knowledge, company knowledge, and like the classic strategic positioning, and I would divide that between strategic position and also how do they look, like the benchmarking analysis. So, the classic financial ratios of how do the margins look like? How is the growth projections? All of that benchmarking, which is part of also of the industry, but let's say specific to the company.
And you get that, you understand that, and you acquire that knowledge from what? Looking at annual reports, looking at Bloomberg?
Yeah, looking at annual reports, reading research, equity research, right? So attending the different annual shareholder meetings, listening to the analyst calls. And then the last piece is valuation, which is, is the classic. You need to have a DCF, public comps, present transactions, and LBO. So you put all of that together, and that is the analysis of what you add to any process, any given process, right? People would look at the M&A guy and the actually, that's a difference. There's a slight difference. I was in a sector team. What that means is that I was covering inside industrials. I was doing the three products. So I was doing equity raising, debt financing, and M&A. The majority of my time was M&A, but I was doing the three of them. There is another team called the M&A team, which are more looking at the process of M&A. So they would cover any industry.
Right. Okay.
Only M&A processes. So they know, but they are not. Sometimes they do it, but they are not suited to the valuation of a company, because you are the expert on that industry. So and you are the expert on that company. So the valuation comes from the sector team.
Okay. But then, where does the presentation element come in?
You mean when you do the book, or?
So, I hear a lot of, when you're a graduate, you're spending hours till late in the morning just doing.
So yeah. So so this is on paper what you do now, day to day. What do you do? As an analyst, you normally don't see the model until you are in year 2, 3, or you see pieces, or you update the model, but you're not in charge of the model. That is the job of the associate. It changes from bank to bank, team to team. Like in industrials, they actually, we had a very good culture of the analysts were involved in the whole process, but some teams are like silos where the associate takes the model. And therefore, if the associate is taking the model, you as an analyst, you are more in charge of putting together the presentation and updating, the industry pages, the benchmarkings. So there's a lot of PowerPoint involved to that extent. I mean, you obviously use the Excel to create the backups, etc., but there's a lot of PowerPoint involved. Yeah.
So it's basically you're taking that sector analysis, the company analysis, the valuation, and putting all of that into a presentation.
Correct.
Okay, clear. Okay, interesting. And then, okay, that's perfect. That adds a lot of color. That's very helpful then, Aj. And then why are the hours so long? And was it, you hear about this on the outside, but was it unexpected for you when you got into the company, just how long they were and how strenuous they are, or was it as expected?
So, okay, no, it's a very good question. So, I think the hours are so long simply because you are dependent on the client. So these are very demanding processes. Where everything is unexpected, and at the same time they are processes that drive a lot of value, can create and destroy a lot of value in a way. Said differently, the numbers need to be correct, right? It's not like
it's time sensitive, no?
So exactly. So you would get a call from a client, and we can talk about the M&A process very quickly, but there are different rounds where different parties are invited, and by the deadline you present your offer. If you are one of the top 3, you get on to the next round, right? And there's more information given to you. You need to refine your analysis and then go to another round, right? Sometimes a client or the seller will call you and say, hey, you are 5 million lower than the next guy. Can you sharpen your pencil? What do you need? What do you need to get to bridge that 5 million and pay a bit more, right? So then you would say, oh, actually, you haven't sent me the customer contracts. Oh, sure, I'll open them to you. And then they open it, and then, but you have 24 hours to answer. And then suddenly they open it in the VDR, and there's 200 contracts, right? You also have lawyers, consultants, etc., right? But you need to,
I did career talk with my friend Anand, who works at Linklaters, managing associate in competition law, and that's something he said is the reason why you're working such long hours is because your clients are very demanding people. Like they want the work done quickly, accurately, and they're paying banks and associates a lot of money, and so the expectation is, listen, we need this done quickly, and so. Okay, no, that's interesting. I just sense it on time. I know you have a meeting as well. So that's brilliant with M&A. Now you're in PE. Could you maybe tell us why you made that change and like what kind of things you do in PE as well?
Yeah. So why did I make that? Why did I make the change? I really enjoyed my time at Credit Suisse. My team was amazing. My MD and then mentor was incredible with me. I did 3 years there, and I reached the point where I was turning associate. So it was in a way the time for me to think about what did I want to do. The thing I didn't like about M&A is that after M&A and investment banking in general is you do the financing for a company, you do the M&A for a company, you buy a business for a company, or you buy a business for a private equity, or you sell one of the divisions, right? And then and this will sound a bit cliche, but then you walk away and you don't see what happens. So after all the analysis that you've put in to the transaction, then you don't see what is the outcome, right? And that was something that for me, it was difficult, or I saw it as difficult for me to continue there. So then I said, okay, let's move to the buy side when I am the client in a way. And now, what did I like about the private equity compared to M&A is exactly that. So now my time is divided 50-50. 50% of the time is portfolio management, so working with the companies we've invested in to improve them, to work with them, to do the strategy, talk about the financing, etc. And then 50% of my time is looking for new opportunities, analyzing new investments, etc. Right? So but if I buy something, or I will continue with that, not my whole life, right? That's the investment period. So,
like you said.
yes, exactly. So you build that relationship with the management team, you build that relationship with the different stakeholders in all the company, right? Which I think is very fulfilling, and I really like. Yeah.
Couple of things, Naj, is with private equity, there's, just from the names, a giveaway, there's a lot less information out there than there is like if you're analyzing Pepsi or Apple or Bank of America.
Correct.
Like, how much tougher is that when you're trying to find research on a company? Do you have to be very reliant on what management are saying? And then does that actually open up some, misaligned incentives? You see a lot of things in venture capital where, you're taking the word of management, but how do you know management is saying the truth? Like, maybe talk to us a little bit about that.
Yeah. So, no, that's a very good question, because the main difference is that I don't have analysts in equity research that are doing projections that I can base my analysis on. I need to do my own projections, right? And most of the time, what I will do is ask management what they think and then analyze that. So there's a lot more of critical thinking, of analyzing, sometimes from the outside, but we also have a lot of experts and industry veterans that work with us, and that will look at the projections from management, and will look at the assumptions, etc., and can validate those. We also work with consultants and third-party advisors, but at the end of the day, as I'm focused on, in my current role, I'm focused on a very relatively niche industry. Once you start analyzing data centers, fiber, or towers, or you get that knowledge, you are also more suited to look at the investment at the end and validate the projections. But I build the projections myself, if that makes sense.
Okay. Super interesting. I want to talk to you about Cineworld, okay? Because this video goes out next week, Friday, and it will be after the end of the Cineworld newsletters. And the company runs into issues with M&A, because in 2018, the company acquires Regal Entertainment, which is like one of the biggest cinemas in the US. They become like the second biggest cinema chain in the world, but then their net debt to EBITDA goes up from around 1.3 times, I think, to around over 4 times. And their plan is, we'll pay this debt down gradually over the years. Even without the pandemic and stuff, though, I think their plan was to pay it down to around 2.5, 3 times, which is still fairly high for what they were expecting. But then obviously the pandemic comes along, revenues get blown to nothing, pretty much. EBITDA's nothing, they can't pay down the debt, and now they're in a lot of difficulty, and they've declared bankruptcy in the US. In your opinion, it's a tough call to say, but what do you make of that? Is that unlucky that the pandemic comes along and they're not able to pay down debt, or is it more foolish? Because one of the titles in the newsletter is unlucky or foolish. Like, is it foolish to lever up so much, like, and put your debt to EBITDA as 4 times, and then you do need things to go perfectly to really like everything to work out? What are your thoughts?
Well, I think at the end of the day, investment management is a big part of it is risk management. Having the company run at 4 times EBITDA, this, leave aside the pandemic, right? It's already, or it sounds like it's very risky. I don't know the industry myself, but it sounds like it's already risky. So what they should have done probably is analyze the level of risk of that entailed, and then try to measure it.
I guess what you're saying is that element of risk. If it's a very stable company, like the company's EBIT margins are strong, around 15% consistently, so that all looks fine. But then when you play into the fact that cinema attendance has been flat or going down like the last few years, there's the worry then, is that like, if your revenues are maybe having pressure, then you're going to struggle maybe down to pay down that debt, and then running at 4 times EBITDA is an issue, as you're saying.
Yeah, and there are other things that I don't know specifically about this case, but that you would need to look at, right? So, for example, what is your interest coverage ratio, which means from all the interest and the debt that you need to repay every year, how much of that you are covering with the cash flow that you generate, right? If it's 1 time, the moment you lose $1 the next year, you're not going to be able to pay So that's one. The other one, for example, is I know interest rates, right? So for I don't know if they had a floating rate, if they had a fixed rate. So there's ways of analyze or at least looking at. I'm sure that when something like that happens, it's not for only one reason. It's not because there were a vortex. There were probably a couple of factors that then lead to that default event. But to your point, yes, the big or one of the things that are very, very important in any of these businesses is what is the fixed cost and what is your top line, right? So if your fixed costs are 85% of your revenues, meaning for every dollar that you get, 85 cents go out just in fixed cost that you can't reduce, then every fluctuation there is going to hit your P&L and hit your bottom line and cash flow very quickly. If everything is variable, right, you sell less tickets, but say, for example, a shoe company, right, Adidas, they might sell less shoes, but then they produce less shoes. So in a way they are, but it's a tough industry, I think.
No, it's interesting that what you said there. It's a good color for people interested in the space that, there's so many things to look at. It's not one thing. You're looking at interest rates, looking at interest rate coverage, all of that kind of thing as well. So no, helpful. And then the other side of this, why I thought you'd be the perfect person, Naj, is, at the moment, as you said, the company's declared bankruptcy. CVC and Elliott Management, I'm not sure if you know this, but they're actually looking to acquire parts of Cineworld. So like Eastern European parts, but not the UK and the US parts. Like, why are they staying away from the UK and US parts? They're trying to buy the Eastern European parts. Is that common in private equity? And also in private equity, to my understanding, you're looking to buy companies with fairly low debt, then you lever them up. Whereas this company is already saddled with debt. So talk us through that.
So private equity, very, very simplified. There's three ways of creating value. One is you buy a company with 100 million of EBITDA and you grow the EBITDA twofold or 3 times, right, in the next 5 years. How do you do that? Cost savings or top line growth, right? Because you think you can. The other lever is simply, as you said, levering it up. So there's a company with low debt. Instead of paying 10 for the company, you pay just 2 because you put 8 times of leverage. Right? So you've paid very cheaply, and it's a very risky way of creating value because it's probably what happened. Well, it's not what happened to this company, right? But you can run into similar problems. You can run into the default. But that's the other one. So financial engineering. The last one is buy it very cheap. So if you think that you can sell this for, I don't know if you've talked about EBITDA multiples, but say you can sell it, normally you would sell it for 8 times. As it's in a bankruptcy, what you are paying is only the debt, probably, to acquire the company. So you might be paying 4 times for something that you believe is 8 times. So if you combine that you're paying 4 times and you're putting some leverage, then you think there's a lot of cost cutting to be done. That's probably what CVC and Elliott, again, I have no idea, right? But that's probably where the angle that they're seeing. Now, Eastern Europe versus the UK and the US, again, without knowing anything, probably what they're looking at is what are the headwinds or the tailwinds in the industry. So what I would look at is 3 angles when you analyze a company. One is the fundamentals of the company, right? If it's a good company, and as we said, can you cut costs? Can you grow the top line? Can you make it more efficient?
It's funny, isn't it? Like in the newsletters, pretty much I spend 2 days just focusing on that. Like the Tuesday is always, how does the company make money? What's happening in the top line? Then the Wednesday is what are the company's costs? And that is the 2 things you just need to focus on. Pretty much for every company, it comes down to those 2 things, no?
Yes. Well, it's those 2 things, and then I would add 2 more. One is strategically, it can be a perfect company, it can be an amazing company. But if the macro doesn't help, or strategically it doesn't make sense. So for example, would you invest, can be an amazing company, but do you want to invest in, I don't know, Spain, or do you prefer to invest in Ukraine, or do you prefer to invest in, right? Like the strategic, what I would call the strategic or the macroeconomic change, and then the tactical moment, right? It can be the best company, Apple, in one of the best countries, the US, but the valuation is too high to make it a good investment, right? So I think that's where they're playing. So say I'm going to speculate, but why would I invest in Eastern Europe? Maybe the streaming services are not as developed in Eastern Europe versus the UK and the US, and they think people will continue to go to cinemas.
Yeah.
Maybe the
Sure.
COVID restrictions and all of that, they were not as bad, so people continue to go to cinemas, and they, I don't know. I have no idea.
So I cut you off naturally. So fundamentals is one. What were the other two that you're going to say?
Is fundamentals, what I would call the strategic considerations, or macroeconomic.
Yeah.
Right. It can be a great industry, but it's not a great country, or it's not a great company, but it's not a great industry. Say a tobacco company.
Yep.
Might be an amazing company in a great country, great environment, regulatory environment, but do you want to invest in that? I don't know, and I don't want to. Right, it's a question for everyone. And then the last one is tactics, so or the tactical, if it's a tactical move or not. So if it needs to be at the right price, or call it price, right? It needs to be at the right price. Is the right moment in the cycle to buy this company, or is it already overvalued? And it can be an average company in an industry that you think is, with some regulatory headwinds, but is super cheap. So, which I have the feeling is more this case, right?
Okay. No, super interesting, Naj. I'll move on quickly. So to be honest, that is all the technical questions. Now it's more like personal questions.
Not the fun part.
Not the fun part, exactly. So actually, we'll go with this one. Like, what do you enjoy and not so enjoy about your role, Naj? Because obviously, I think you find it fairly intellectually stimulating. You get paid well. The hours maybe aren't so brilliant. Like, what do you enjoy and not so enjoy?
So I'll start with what I enjoy. I enjoy that I'm surrounded by very talented people, very, very, very smart people. Not only people within my company, but also I'm speaking with management teams, with CEOs, CFOs that are industry veterans. They know a lot. So what do I like about that? It's not that I like to surround myself with people, right? But it's more that I'm learning a lot from those people. That's my main. That is what I like the most. I like specifically about this company. I like the culture. It's very good. It's a very good culture. So I'm very happy with the team. I'm very happy with, in general, coming to the office and seeing these people is good. I guess that's a good sign. And I like that. I think it's intellectually challenging. So it's not only that I'm learning from people, but also I find everyday challenges, say problems to solve, that I find interesting and then rewarding when things go well or when we solve them. The things that are a bit, I wouldn't say that I don't like, but there are things that people should consider before moving into the industry. It comes with sacrifices. So the same way, at the end of the day, this is like professional sports, right? Or we are very, I wouldn't say sophisticated, but it's a very niche industry doing things that are very specialized. And as such, you need to be, you need to devote a lot of time and a lot of energy, and probably also, to the industry and to be better. It's a very competitive industry as well. So those things are things that I like and I don't mind doing. But there are choices. So I think it's probably that would probably be the summary, right? Maybe I have an answer without answering, right? But it's true that obviously you don't work 9 to 5, right? I work 9 to 9, 10, and but I don't mind working those hours because I really enjoy it. And I think that should be the purpose of everyone. I wouldn't do this for cricket. I know you love cricket, but I wouldn't stay 9 to 9 playing cricket. So.
No, I think it's a good point. And I think it's a good question, a good thing for the people listening, the audience for this call. You got to work out, it's very different for each different person, their different like lifestyle habits and stuff. Like if I work 9 to 9, 9 to 10, Tia would not be happy. Like, and not even Tia, like, I don't think I would want to do private equity for 9 to 10. And so like, I have different motivations, different things that I enjoy. As you said, I might play cricket from 9 to 10, but no, like, and consulting and the work that I do, I really enjoy. So it's picking your own interest that you want to dedicate.
It's your life choices, right? And it's very personal. It's very personal.
If you could go back and tell, you're now a wise older man, Natch, but if you could go back and speak to younger Natch, Are there any books or courses that you would recommend to aspiring M&A or PE students, like, or even technical skills that you think they should get involved in? Is there, the accretive dilution analysis or LBO analysis? What kind of stuff would you have said to do?
I would say for young people, I think getting into finance, accounting is very important. And I heard you say this, I don't know if it was in one of the newsletters or one of the videos, but I completely agree with that. Accounting, despite some people not finding it very interesting, I am not the greatest fan of accounting, but it is very, very important, I think. Yep. And then what I would say is put as your number one priority learn and learning, right? If you're in a course that you don't think you're learning enough, move to another one. And with that comes challenge yourself and try to be uncomfortable, right? Put yourself into situations where you might not see, that you are at the beginning, or that, when you think about them, you have that feeling that you're not going to be comfortable, or it's outside your comfort zone. So if you are not a great speaker, maybe go to a debate class, right? And you will enjoy it, because that is when you move on and you fulfill those type of pressures and challenges, that is when you grow a lot and you like it, right?
It's so interesting. Yeah, I think this is the 5th or 6th career talk, and so many people have said do a debate society or public speaking. I mean, it's a relationship business, no? Like, you have to communicate well with the management or the managers. You have to communicate, and I think that's what we're trying to get across to so many people is like, communication is critical. So do what you can now as a student to develop that. I want to, those technical skills like dilution or LBO and stuff. Like, how much should students focus on that in undergrad? Or is that something they could learn once they've joined the industry?
I think that's something that they can learn when they join the industry. Yes.
Okay.
I think what people should be focused on, in particular accretion dilution, because it's a very specific. But I know that was just an example. But say if I were them, I would focus before the interviews. I would focus on accounting, knowing accounting very well, valuation, and there's 3 things in valuation: is DCF, public comps, percent transaction, and that should be easy. And then I would just be curious about macroeconomics. So it's a tough subject, but that is something that drives everything. So knowing what are the implications of interest rate hikes, what are the implications of a tax cut, what are the implications of, all of that, I think is very important. And those are the 3 things that come to mind.
And the business of newsletter, obviously.
Of course. You can get all of that every day in your mailbox.
We've got about a minute left before the Zoom cuts us off. Any final thoughts or any advice that you'd give yourself if you could go back 10 years? Any advice that you would have told yourself to do differently, or you're happy with how things have turned out and you wouldn't change anything?
I'm happy how things turned out. I would do your I'm very happy how things turned out.
And any challenges that you've had, you learn from them, as you said. Like, learning is the most important thing, so it's not trying to take them away.
I really, really think, and maybe it was not what I said before, but I think the master's is very, very important. And if you can complete your education before you get into your career will be 40 years, 42 years. There's no rush into getting into your first year. So learn, train yourself. All of that is time well spent. And I'm very glad I met you at IE. We sat next to each other, but
thanks so much for your time, Nach. And I knew we would struggle to keep this to half an hour. I think it's going to be about 40 minutes, but no, I appreciate your time. I'm sure it's going to be super useful for people who are interested in M&A, PE. So yeah, appreciate it. Thanks a lot, mate.
Thank you. It was a pleasure.
Cheers, man.
Speak soon. Bye, man.